Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about if we are in a recession, if there's going to be a recession, what do we do if there is a recession, and most importantly, what is a recession? Because I'm sure a lot of people have heard that word and maybe not really understand what that typically means or what that means for the average person like yourself, I, the viewer, and just everyone around the world. If you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So before we get into that stuff, let's just go through the portfolio real quick here. Today was a great day. Portfolio closed out at $11,570.07, up $57.24. For the week, we're up $239.47, up 2.11%. For the 1 month, we're up $159.83, up 1.4%. For the 3 months, we are up $404.66, up 3.62%. For the 1 year, we are up $1,786.81, up 18.26%. And for the all since starting this portfolio, we are up $2,373.54, up 25.81%. So today in the market is just roaring back. Now let's not get our hopes up, because it seems like when this tends to happen on a day where we've seen just a hammering on the market day over day, it could just happen tomorrow. I mean, we're on a rally, I think, for the past since last week, coming into today, and then we'll see what happens on Tuesday, or not Tuesday, but Wednesday, when you see this video, which is today. Most importantly, we're going to talk about what is a recession, and then we'll get into how we figure out if we are in a recession, and then what you should be doing if we are in a recession or preparing for a recession, and we'll go through a few terms and things like that. So what is a recession? A recession is a slowdown typically in the economy when it comes to growth. And how does that happen? Well, first of all, inflation is a big factor in a lot of this stuff, especially when it's like quote unquote hyperinflation, which I don't know if that's currently where we're in, but prices of goods are going up, the cost of living goes up substantially, where it's noticeable very quickly. So what typically happens is wages will typically stay the same, go up a little bit, and then that person will take that money and usually purchase goods at that, which creates a profit for companies, which gives them the ability to grow, which gives them the ability to come up with new products and sell them to the consumer, which is you and I. And when things cost more money, people typically will spend less, which means companies will typically make less, which overall creates this feedback loop of slowed economy growth. So when that happens, we typically go into a market downturn, because the stock market is typically an indicator of how companies are performing. Usually, I know that's not the case in recent times here, the last few years here, and that will cause a recession. The thing about a recession is that we won't know if we're in a recession till maybe 6 to 24 months out, or 1 to 2 years if you're the year person over the month person. And you may feel like, why is my dollar not going as far as it did last year, or the year before that, and the year before that? And to give you an idea of the last recession we had was the 2008 financial crisis, where it was very apparent that we were in a recession, but we didn't determine that we were in a recession till maybe I think it was like 60. It was probably a year out, and it was deemed a recession. The thing is, the board that determines that doesn't actually determine that we were in a recession until we've actually come through it, or it's already been a year or 2 years into the recession. And so it's not really a good time, because it can really financially damage everybody in a very bad way. What are some things that you can do to prepare for one, or if we are in one, because we can't really tell until the data comes out and the information is provided accurately. The first thing to do is really be as liquid as you possibly can. And that term being financially liquid or having liquidity is a term used in the financial world to determine how fast you or how much access you have to cash right away that you can use in times of recessions. To give you an example of liquidity, just so that we understand the term, is if you can imagine that water is now the currency and not paper money or dollars or whatever currency you use. It's a block of ice, and your currency to buy things is water, but you have this block of ice and you have to go through a process to liquidate, which is a liquid, to liquidate that ice into a currency that you can use to purchase goods. And that's what it means by liquidity. How much quote unquote liquid or water do you have to use to purchase goods? So we can change that into like assets. Okay. So if you own real estate, you can't, if you've never owned a piece of property, one thing you should be aware of is that you can't just sell your property without going through a process. So you getting access to that cash can sometimes be difficult or time consuming, or it can be a prolonged time period before you can have access to any kind of dollars to spend to live. That is one of the probably most illiquid ways to get access to cash. Stocks, securities, mutual funds are relatively in the middle. You can get rid of them quick. Sometimes you can't sell positions fast enough. I know it seems like we can, but there are some cases where if you own a position in a company that maybe does not perform very well or is not, I guess in today's world, very hyped up, it could be very difficult to get rid of those shares. So you have liquid access to the cash. And so you're kind of in the middle when it comes to stocks or securities and shares. That is one thing to be mindful of. The other thing is, now there are other strategies. Let's say you have a home, you can get a HELOC, secured line of credit, which gives you access to the equity in your home, which would give you access to the cash. However, you're just putting yourself a little bit more in debt in order to get that cash. Which brings me to my next point, which is to reduce the amount of debt that you have, especially any high interest debt like credit card debt, revolving lines of credits, and anything of the sort. If you're feeling like maybe our cost of living is going up, the other day I bought gas, full tank gas, 60 liter tank roughly, cost me over $100 on premium gas. And yeah, it's not fun. And it really puts everything really into perspective when you're used to spending like 75 to 80 bucks on gas, and then all of a sudden you're spending $100 just to fill your tank. That's a $20 increase from what I used to pay. And yes, you might be like, oh, that's not a big deal, but it's noticeable. It's not a margin of error. Okay. It's very noticeable in that sense. So reducing your debt is a good thing, especially in times like these. It's probably one of the most important things that you can do, because believe it or not, interest does compound, just like our portfolios compound over time. Compound interest can be a great thing for investors, but it can also act as a not your friend kind of way and compound in the other direction into debt, which makes you much more poorer in that sense. The best thing you can do is get rid of any high interest debt as fast as you possibly can, and then move on to the next interest rate. And I'm sure there's tons of videos on how to pay off your debt. Now, if you're having troubles with that, I guess that leads me to my next point, is trying to increase your income by maybe taking on another job, as much as we don't want to, doing side gigs, just bringing in more money to help you reduce that debt or build your cash reserves in times like these. and maybe even develop a new skill set, because we know the marketplace is in dire need of employees and in dire need of special skill sets that are required in this day and age. So maybe it's time to maybe learn something new, and really add value to yourself and add value to the marketplace by developing your skills, getting a new skill set, and creating a lot of value around yourself. Because I'm sure even in these times, a lot of people don't want to do that, but it does give you that advantage over maybe those other few to land you maybe a job that could give you 10, 20K more than what you're currently doing. And it might be a good change. Maybe it's time you did not like your job and now you like something else, and you want to make sure that, mentally, health wise, you're a bit happier in those places where you can perform and thrive. Those are typically the three things that I would say you can do. Aside from building an emergency fund, which you should have something for 3 to 6 months, just in case you get let go from your job or something like that happens. But I doubt that will happen because a lot of employers, a lot of companies are looking for employees, and there aren't enough employees. The recession is not really good, and we'll never know until it's told to us. And it's typically found out maybe 6 to 24 months out, 1 to 2 years, that we were in a recession. But this is the best way to prepare for a recession, is to build your cash reserves, pay down debts, and just make sure you're in a good position if that were to happen. Because it can be financially detrimental for a lot of people, especially those that maybe are looking at retiring in the next year or 2 years. It's going to be tough because in 2008, a lot of people lost 30-40% of their retirement, and that's not fun. I mean, you spent your whole life building that up, and then all of a sudden, your whole life savings or your plan for retirement gets chopped by 30%. Could you imagine that? Losing, let's say you had $1 million for retirement, which I don't think is enough. You lose 300,000, like that's a lot of money. That can do a lot of things. Or you might have to even prolong your retirement and work another job for another couple of years just to maintain the hope that you're going to have enough money in retirement. That is pretty much it for the video, guys. I mean, hopefully you did enjoy. I know it's maybe a bit all over the place, but those are my biggest 3 points, just because I keep hearing about, recessions and market downturns. And again, just because your stock portfolio is performing does not mean that you're making a ton of money, that you can continue to live your life the way you are. It's not always great to use that as an indicator on cost of living or anything of the sort. So before we end the video, guys, we do have a referral. We'll go ahead and reveal that award. They changed this up a little bit. Helka Mining, so deposit that reward and maybe later. And it doesn't show who funded that one for some odd reason. Oh, it did. So Unica Jed, thank you so much for watching. Thank you for using the referral code down below. If you haven't, till March 24th, it will give you 3 free stocks. Currently, we have $730 total from referral. So thank you so much, guys, for using that. I really do appreciate it. And it does get put to use in the portfolio, of course. So thank you for helping me build the portfolio. So other than that, guys, hopefully you have a great week. Don't forget to leave a like and subscribe, and we'll see you in the next one. Bye.